Hi and welcome. This is Ken Boyd, and this is the Accounting Accidentally podcast. What we try to do in the podcast is to take something that has happened in business news and relate it to accounting and finance topics, a way of explaining them and make them a little more clear to our audience. As you can see, this is the St. Louis Test Prep homepage. stltest.net is our webpage if you're listening on the audio. Essentially, what I do is do business writing, speaking, and explaining. I tutor a lot of MBA and CPA students online. I do some speaking for a number of institutions. I record video content for several clients, and I also write dummies books. And you can find all that at stltest.net. NET. You can also find the blog where I blog about all the topics that I podcast about at Accounting Accidentally. If you Google that blog, you'll find our blog. So there was a great article that came out. I happen to have the USA Today report that was reported all over the media on August 1st, 2014. P&G to shed more than half of their brands. Procter & Gamble, we know, it's been around for dozens and dozens of years, decades. They make and sell a lot of name brand products that we all buy. A lot of them are mentioned in this article. Products like Tide soap, Ivory soap, things like that. Things that we buy all the time, consumer products, consumer goods, if you will. So we find out some interesting things in this article. I moved some of them into a Word document, which I think is a little bit easier to see. I'm going to scroll up here and get to the points I pulled out of the article. So the first thing is the headline: the company will sell and exit 80 to 90 to 100 even of their mostly minor brands in a bold attempt to refocus their business behind 70 to 80 remaining best-selling brands. So this is a company that's selling more than half of the product lines that they make. And the question is why, number one, and number two, how did they decide to sell those brands? Well, the first thing the CEO says is the size of sales, that is the total sales of a division compared to the other divisions, won't be the only criteria for selling brands. And where we're going in this discussion is we're going to get to a discussion of sales mix. That's where we're going. So just because you sell more than another brand does not necessarily mean that you're going to stay and the other brand goes. In fact, the CEO says, we're going to unload even large brands that don't fit into our core business. Most businesses have a core business, what they do well, businesses they think they can grow, businesses they think that they understand well. Okay? So they have a core of beauty, fabric care, and other businesses, products that they sell. That's what they think they're good at. That's where they think they can succeed. Therefore, they're going to get out of other businesses that aren't related. So they don't want to be in businesses that are not growing. They don't want to be in businesses that are low margin, and by that they mean profit margin, which is net income divided by sales, or commodities. Now, what they mean there is not necessarily farming commodities like corn and wheat. What they mean is a commodity where a product is viewed as a commodity because the consumer doesn't view much difference between products A, B, and C. So we all have preferences as consumers. For example, we may feel like, I don't really care what kind of body wash I buy. I could buy the name brand Ivory or Dove, or I could buy the generic brand in my grocery store. I think it's all the same because I view body wash as a commodity. So they don't want to be in that business because you can't raise the price of a commodity. So that's what they mean by commodity. And he says if it's not a core brand, even if it's a $2 billion brand, meaning $2 billion in sales, we're going to divest it. So I put a headline here that there is a real strict assessment on profit, not just sales. So if you can make if you can earn 20 cents by selling $1 for one brand, and you can make only 10 cents selling another brand per dollar, you're going to sell that 10 cent per dollar profit margin brand, even if it's a whole bunch of dollars, because you're simply not making as much money with those dollars. Higher profit also means we're going to make more cash, and we're going to make more cash faster and collect it faster. I mentioned collect cash because as we get later into this podcast, you're going to see a pretty amazing statistic about how quickly Procter & Gamble collects cash. So they say, the CEO laughingly says, less will be much more. The objective is growth, a much more reliable generation of cash and profit. So I've been saying for years that most businesses that I've seen, that I've worked with that fail, don't fail because they're not profitable. They fail because they can't collect cash fast enough to pay their operation expenses each month. So even though they may have a profit margin, if you don't have enough cash to operate, you're going to have to go out and get another investor or even sell yourself completely to get the cash. So this CEO is focused on that cash. And he says here about what he's going to keep 70, 80 top brands that generate 90% of sales and 95% of profits. So they're keeping most of the stuff that generates sales and profit. So that it also indicates a lot of what they're getting rid of is small stuff. They then bring up a term, and I put this term under the heading is look how much better. That is, look how much better off we're going to be when we get rid of these other lower performing entities. And they use a term called organic sales, and they use the term in their annual report as well. And they define organic sales as sales which remove the impact of foreign exchange, acquisitions, and divestitures, sort of like the term same store sales for a retailer. In other words, let's take business that we had at the end of last year and compare it to the same business we have at the end of this year. So we were in those businesses all year long. There's no distortion because we sold something or bought something, which is acquisition or divestiture. And what the CEO says is we would have grown at 4% rather than 3% had we not been in these other, what he calls, non-core businesses. And a last point in terms of the article is an analyst from Bernstein says that by cutting all these costs, they're going to be able to reinvest those dollars, those extra profit dollars, into growing those other businesses. So that's the first point. The first point is the P&G article and what they've decided to do as of early August of 2014. Next, what I do is jump to the annual report. And pginvestor.com is where you can find the annual report. And I'm on page 3 of the most recent annual report, the 2014 annual report. 3 really interesting points are made in that document. Organic sales growth was 3%, and again, we found out that had the company gotten rid of their non-core businesses, they could have grown at 4%. Pretty big difference, 1% difference for a company that large. That's a lot of sales growth. They then say that our progress on working capital, which is defined as current assets less current liabilities, and capital spending productivity enabled us to deliver a 98% adjusted free cash flow productivity. So let's define what that means. First of all, free cash flow is defined in Investopedia. Is a measure of financial performance calculated as operating cash flow, that is, cash flow from operations, cash flow that you make by running your business every day, as opposed to operating from financing, which is raising money and paying it back, or operating cash flow from investing, which is buying and selling assets. So operating means cash flow from your day-to-day business. So free cash flow means if we look at that cash flow from our day-to-day business, in Procter & Gamble's case, making Tide laundry soap, less our capital expenditures, That's free cash flow. Adjusted free cash flow, which is what the CEO uses in the annual report, the firm uses, is free cash flow excluding gains and losses from divestitures and impairment charges. Impairment is that term for an asset being impaired, most normally goodwill, where the value of an asset is permanently declined and you record an expense for impairment. So if we sort of get rid of all that distortion, if you will, what this means is that this company's day-to-day operations is generating a huge amount of cash. They are selling a product and collecting it very quickly. Another interesting statistic, I thought, is that Procter & Gamble says we returned $12.5 billion in cash to shareholders, which was 110% of their net earnings. Now, they did that two ways. $6.5 billion in dividends, which is paying a share of earnings to a shareholder, and $6 billion in repurchasing shares of stock. And obviously, if you take shares off the market and there are fewer shares in the hands of shareholders, all things being equal, your earnings per share is going to go up because you're now making more dollars based on fewer shares outstanding. Earnings per share is net income available to common shareholders divided by shares, common stock shares outstanding. That's the denominator. So if you reduce the number of shares, you reduce the denominator, that number, that fraction is going to go up. And it says they raised their dividend by 7%. So really interesting statistics, I thought, about Procter & Gamble's performance. What Procter & Gamble is really getting at is something that I talked about in Cost Accounting 21A, that video, and also in chapter 13 of my book, Cost Accounting for Dummies, which is sales mix, the mix of the products that you sell. This is a simple example that I've been using for a long time, talking about a company that has two products. They have two divisions, one in Chicago and one in Stuttgart. Two products. And you'll see that we have units of sales. Sales less variable cost equals contribution margin, which is a basic concept for cost accounting. And we have something called budgeted sales mix. And budgeted sales mix is simply the percentage of your total sales that are in one product. So for example, for the Chicago product, 200 units sold, of the Chicago product divided by 500 total units, 40% of the sales are in the Chicago product. That means 60% are in the Stuttgart product. And what you can do then is take that sales mix and you can change it. And what this is all driven by is to try to get an apples to apples comparison of which product is more profitable. So the first step is you've got to look at net income divided by sales to get plain old vanilla, what's the profit margin? So if I make 20 cents per dollar, I have a profit margin of 20%. We can complicate the conversation by talking about sales mix, which is, what if I mix my sales together in some ratio? So if you're Procter & Gamble, what if 20%, making it real simple, what if 80% of my sales are in Tide soap and 20% of my sales are in Dove soap? How does my profit turn out? How does my profit turn out? So in this case, you can have a budgeted sales mix. Every company at the beginning of the year hopefully does planning and budgeting. Maybe Chicago was 40% of your sales and Stuttgart was supposed to be 60%. But then you look at your actual sales, and let's say that Chicago, that product was only 43%, Stuttgart was 57%. What you can then is go into the formula, the variance formulas, to figure out how that affected your profit. That is the difference between your budgeted and your actual sales mix, and how did that affect your product. Now, the numbers get a little complicated to do in an audio podcast. But essentially, what you're doing is taking your actual results less your budgeted results and comparing and coming up with a variance. So, actual results would be, well, what's the total contribution margin? In dollars, what's the total contribution margin, sales less variable costs for all of the products I sold? So in the example I have online, it's $105,000 budgeted, $105,000 total dollars contribution margin. Because of the sales mix change, what actually happened was when I add up all of my sales, less all my variable costs for all products, the actual contribution margin dollars is $115,625. So I am better off by a little over $10,000 by having a different mix of products than I planned. And you can imagine that Procter & Gamble goes through the same discussion for themselves. What's the best mix that will give me the best contribution margin? And lastly, the reason we use contribution margin is variable costs can be directly allocated to products for the most part. Fixed costs are more difficult to allocate. So the best way to look at an apples to apples comparison when comparing products you're going to sell is to look at sales less variable cost, see how your profitability turns out, and then you throw in fixed costs at the end because regardless of how you mix your sales, your fixed costs are what they are, and you just throw that in and come up with your profit. So in other words, you can't really manage your fixed costs nearly as well as you can manage your variable costs. That's as far as we'll get on today's podcast. Remember, on the website, stltest.net, you have the homepage here that explains what we do, the 3 books, Accounting All-in-One for Dummies, Cost Accounting for Dummies, and the new book, The CPA Exam for Dummies, that will be out in September of 2014. You'll also find our blog. You'll find links to all of our videos on YouTube, all on the site. Thanks very much for listening to the podcast, and we'll see you next time.